when I combine my financial management and advanced financial management students, the Zoom live classes, we have 600 in total, 600 in total. So 60, that gives me 10%. Of course, the mistake is mine. It's because I began doing this much. I shared the link much later. I should have given the link mapema kabisa. So ladies and gentlemen, today we're looking at capital rationing. So when you talk of capital rationing, remember capital rationing basically refers to what we call limitation of funds. Limitation of funds. Limitation of funds. Where, for example, you have here amount available, amount you have in this case here for investment perhaps could be 10 million, but the amount required is more. The amount required is more. Perhaps you need 15 million, but you only have 10 million. So in this case here, there is a ceiling. There is a ceiling here. Anytime we talk of a ceiling here, you can't exceed. So this is a ceiling here. You can't exceed 10 million. Whenever you're looking at your investments, you can't exceed 10 million. Then automatically there is a limit. There is a limitation. So we call that capital not being enough. Capital being inadequate. And if that is the case, then this capital rationing, we are supposed to know that there are two types of capital rationing. We have in this case here what we call soft capital rationing. Soft capital rationing. Soft capital rationing. And then number two, we have what here? We have a hard capital rationing. So capital and what here? Or rather, soft and hard. Soft and hard. Soft and hard capital rationing. Now, what are we supposed to know about soft capital rationing, ladies and gentlemen, is when the rationing is self-imposed. The rationing, the limitation is internal. So, for example, like RCM here, we could be doing, for example, some constructions here and there. So if the management sits down and says, hey, this amount we have collected, assuming we collect like say 50 million from students, we are only but custodians of this money. This money we should be able to collect and of course pay all the other stakeholders, all right? But of course we must also think about, the long-term business, the long-term goal. Long-term, of course, we'd want to have like our own primary schools, our own. So we must be constructing here and there. All right. But we can sit down and say then, if that is the case, if you're going to put some money out of this into construction, the constructions can never spend more than 5 million. We should never take more than, so in this case here, we have put a limit for constructions. We put a limit for this project here. But who is putting this limit? It is ourselves. It is ourselves. It is ourselves internally who have sat down, in this case here as directors, and we've been able to put, a restriction we can't exceed. That's soft. Do you know why we call it soft? It's because we can easily amend it ourselves. We can easily sit down again and say, hey, we are seeing this semester is not very bad. Let's take this limit to 7 million. It's soft. It's soft. It is soft. Soft capital rationing. And then we have, ladies and gentlemen, what we are calling here the hard capital rationing. Now this is externally imposed. Externally imposed. So you know that, for example, the collateral that you have, there is no way banks from outside there will give you more than 10 million. So this is externally imposed. Could be coming from the capital market, All right. So in this case here, you've got nothing, you as directors of this RCM, that you can do to increase the limit, because of course the limit has been imposed by banks from out. It's externally imposed. You guys should be able to use your own examples. And I strongly believe that now you've gotten some little concept here and there regarding these two types of capital rationing. So are we together somehow? Are we together somehow? Are we together somehow about this soft and hard capital rationing? Thank you so much. And then you will allow me to do a question that was tested in financial management. It was tested in financial management. It was tested in financial management, this question. They keep on lifting financial management questions, and then they give them to us in the advanced level. So they brought this in May 2018, question 4C. May 2018, question number 4C. May 2018, question number 4C, and then I'll be able to take a few minutes to discuss like the tips and tricks of these two papers. Tips and tricks of these two papers. So May 2018, question number 4C. Do we have anybody who can easily... May 2018, question number 4C. Question number 4C, financial management. Financial management. Financial management, capital rationing. Is there somebody who can attach this question here? Do we have anybody who can take a photo of that question and then they send the question here? Do we have some good Samaritan there? Any good Samaritan? Any good Samaritan? And then, of course, I would expect you guys always to use our revision kits for revision. These revision kits, you buy revision kits from RCM, and then, of course, they'll be able to really assist you. Great revision kits with CASNEB's questions and suggested answers. Is there anybody who has that question? There is this lady who normally assists Mwalimu quite a lot. I normally call her assistant teacher, Mary Ann. Is she around? If she was around by now, I'm so sure I would be having that question here. There's a way you send it to the group. There's a way you send it to the group pretty fast. Yeah, she's very helpful. I am surprised that also Yvonne, you've been able to see that gift she has. Very helpful, yes. Very helpful, yes. So then what we shall do, as we wait for a good Samaritan to attach it here, because I'm so sure a good Samaritan will be able to attach it here, the first part, they wanted us to describe two types of capital rationing in capital budgeting. Two types of capital rationing in capital budgeting. It is soft, it is hard. Soft is internally imposed, we impose it ourselves. Hard is externally imposed, So for example, ladies and gentlemen, assuming you are earning, say, like 60,000 Kenya shillings, you know, that automatically is an external limitation. If you would want to buy, in this case, a Ferrari going for 3 million, and then you have only a salary of 60,000, not unless you get more money from elsewhere, there is a limitation. That is what you can't do. And that now limitation is really beyond yourself. Remember, hard capital rationing is also known as what here? Uncontrollable. Uncontrollable capital rationing. You can't control. You've got no control over that whatsoever. No control of that whatsoever. So we are told, Roman 2, Amani Contractors Limited is intending to invest in 4 independent projects. The following information relates to the 4 projects. So I can write this down because you don't have the question. So we have here the project. We have A. We have, let me just write from here. So we have here A. We have B, C, and D. There are 4. So they have given me the PVs. They've given me the present values. We have 50, 60, 100. 50, 60, 100. This is 70. They have given me the IO, initial outlay. They have given me the IO, initial outlay. This is 30. This is 45. This is 60. 60. This is 40, like that. And then come straight away and give me what we call the net present value. So give me the net present value. How do we get net present value? It is the total present value minus IO. IO stands for initial outlay. So it is this minus this. So this gives me 20. 60 minus 40. This has been given in your exam. This gives me 15. This minus this gives me 40. 40. 70 minus 40 gives me what here? Gives me 30, like that. Gives me 30 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 like that. I've seen a lady who is calling herself a very good name there. Her Excellency. That's very good. That's very good. That is very good. That's very good. All right. So they've given us, ladies and gentlemen, great things there. They've given us the NPVs, so that has been given. And then look at Roman number 1. We are told the company has a capital limitation of 90 million. So if there is a capital limitation, That is a capital rationing question. It's a capital rationing question. But this examiner was very good because, ladies and gentlemen, the way I normally tell you, whenever you see a situation where capital is limited, where capital has been given, then they want you to calculate what we call the profitability indices. They want you to calculate the profitability indices. They want you to calculate the profitability what year? They want you to calculate the profitability indices. But this examiner does not want you to do that. What does he want you to do, this examiner? What does this examiner want us to do, ladies and gentlemen? So this examiner, what this examiner wanted us to do, first of all, there is what we call additional information. So we have here additional information. And this additional information is provided here. Now you guys can snip this. I know you guys are good snipers here. You can snip this very well. You can see the question now is with us here. Thank you so much, Her Excellency. Her Excellency, for sharing this with us. You're indeed a good student. So this is the question here. Amani Contractors Limited is intending to invest in 4 independent projects. The following information relates to the 4 projects. So we have here projects A, B, C, D. So you can see the initial outlay. You can see the present values. They have given us here the net present values. Additional information, the company has a capital limitation of 90. The company's required return is 10%. Any surplus funds can be reinvested to generate a return of net cash flows of 14% in perpetuity. The projects are indivisible. You can't divide them. Number 5, the projects can be combined to achieve a higher return subject to the company's capital limitation. Now, ladies and gentlemen, please listen to me very well. When you look at the initial outlays provided, there is no way you can combine 3 projects at the same time. You can't combine 3 projects at the same time. Because if you try combining A, B, C, you see 30, this is the capital need. 30 plus 45, that is 75. 75 plus 6, that is 135. You see that will exceed this 90. So here you can't combine 2 projects. You can't combine 3 projects at the same time. So basically here, you can only combine 2 projects, like you can combine A, B. You can combine, for example, A with D. Because you see 30 plus 40 is 70, which is below what here my 90 million maximum capital available. Remember, the initial outlay is basically the capital that I will need, So if I'm given this kind of a question and then they want me to give them optimal project combination, this is very, very easy. Very, very easy. So what I will do, ladies and gentlemen, I know you have been able to snip this. You've been able to take a photo of this. I'm so sure you've been able to take a photo of this. And now you can allow me to drop it down so that I can now take this opportunity to teach here. So please come and give me the combinations. And you said that these combinations, they will be 2 at a time. The combinations here, they will be 2 at a time. So just like in salvation, I will combine A with B, A with C, A with dog. So we have here AB, we have AC, we have AD. No, AB, AC, AD, yes, AD. So we can't say like in salvation, it's forward ever, backward never. Backward never. You can't tell me Mwalimu do BA. BA, no. In my combination, it will always be forward ever, forward ever, forward ever, forward, forward. So I've been able to finish the combinations of A. Then I'll come and do the combinations of B. So B, I'll combine, I can't combine B with A, backward never. So it is BC, BD. So it is BC, BD. So that is it. And then lastly, we have CD, like that. So then can you kindly give me the initial total, the total outlay needed? The total outlay needed. The total outlay needed. So if I combine A with B, my friends, total outlay needed. Total outlay needed. The total outlay needed, what do we have here? Total outlay needed. Total outlay needed. The total outlay needed. The total outlay needed. So if I combine A and B, look at the outlay. It will be 30 plus 45. 30 plus 45, that gives me what here, somebody? 75. That gives me 75. The total outlay needed. The total outlay needed. Total outlay needed. What do I need if I'm combining? If I combine A and C, how much will I need in total? Somebody who is trying to follow, please try to follow. If I combine A with D, if I combine A with, not D, A with C, it will be 30 plus 60, which gives me 90. You're right, 90. So A is 30, dog is 40. So 30 plus 40, this gives me 70. 70, thank you so much. How about B cow? B cow. How about B and the cow being put together? How much will I need in total? B with cow. B with cow, Linda tells me 105. So B with cow, this is B, the outlay is 45, and the cow is 60. So here I need 105. Here I need 105. Here I need 105. How about B dog? B dog, 45, 40. This gives me 85. This gives me 85. Then we have cow dog. Cow dog, in terms of initial outlay, 60 and 40, this gives me what here? This gives me 100. So this is possible. This, we can execute them. We can execute this. But you see, this 105 is more than 90. 90 is what we have. 90 is the maximum that we have. So this is more than 90. So this is an impossible mission. Impossible. 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 The same case here. This is more than 90. So this is impossible. 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 This is impossible. This is impossible. This is impossible. All right. So, ladies and gentlemen, I would want you to do me a favor. I would want you to give me the surpluses. Please give me the surpluses here. Surpluses. The surplus. So if I go for A and B and then I invest 75, remember in total we have 90. If we shall settle for A and B, thank you so much, they've already seen. If we settle for A and B, where we need 75, and I have 90 in my pocket, so the surplus here will be 90 minus 75, which gives me, they're telling me 15. The surplus here will be 90 minus 90, which gives me 0. The surplus here will be what I have minus what I will use, which now will give me 20. This is impossible. This is 90 minus 85, which gives me 5. This is not possible. So up to here, ladies and gentlemen, are we really together? Up to here, are we together really? So we go to the last step, which is the step of net present value. Step of net present value. But now, ladies and gentlemen, I would want in this case here something very, very special here. What have they told us about surplus? What have they told us about surplus? When we get this surplus, tunapita hivi tunakunywa kamunyweso. Surplus. Tunakunywa kamunyweso. Surplus. Wamesema namna gani kuhusu surplus? We reinvest, isn't it? Wamesema reinvest. Wamesema reinvest, yes. Reinvest. Now, I would want to do one example. If we reinvest, what is the NPV of reinvesting? What is the NPV of reinvesting? What is the NPV of reinvesting? Now, ladies and gentlemen, remember the reinvestment, the return will be receivable into perpetuity. Look at note number 3. Any surplus funds can be reinvested to generate a return of net cash flows of 14% in perpetuity. So for example, if we get this 15%, we reinvest this, then we shall get 14%. We shall get 14%. So can somebody give me this? This 15 times 14% is equal to what? What is this return in Kenya shillings? What is this return in Kenya shillings? I'm being given a figure of 2.1. 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 Now, let me ask you a question, my good students. If somebody promises to give you 2.1 every year into perpetuity, are you able to give me the present value? Present value of the 2.1 receivable indefinitely. What will I do to get the present value of an indefinite cash flow? What will I do to be able to get What will I do to be able to get? Divide by 0.14. Divide by, I'm getting very good suggestions. I'm getting very good suggestions. I'm getting very good suggestions. I'm getting very good suggestions there. No, I think I would want to get as many answers as possible. So think fast. Think I would want to get as many answers as possible. Yeah. One thing that I love about you guys, you've just told me that the present value, when n is infinity, you just, mwalimu, take amount divided by R. R is the required return. R is the cost of capital. So it can't be 0.14. It can't be 0.14. This question, we have a cost of capital, don't we? This question, we have a cost of capital, don't we? We have a cost of capital. Are you able to see the cost of capital in this question? Are you able to see the cost of capital in this question? Are you able to see, to the company's required return is 10%? Yes. So like now this will be 2.1 divided by 10% minus 15. Minus 15. Can you kindly give me this answer? 2.1 divided by, so it's amount over R. It's amount over R minus 15. So this is giving me 6. Why am I subtracting this 15? It's because I want to get net present value. And you see, to get net present value, I'll always take the present value minus initial outlay. I'll take the present value minus initial outlay. So for this amount, which I got here as the surplus 15, I'm going to invest it. So the 15 becomes what here? The initial outlay. The 15 becomes the initial outlay. So for me to be able to get net present value, I need to net it off. I don't know whether these guys are seeing what I've done. Because every time they bring this concept of reinvestment, very few students get it right. Very few students get it right. I can see somebody who is lost there. Is there anybody who has been able to understand what Mwalimu is doing before I repeat? Even one student who is able to say, Mwalimu, this one I've understood. Now remember. I mean, how do we get net present value? To get net present value, we take the present value minus initial outlay. Forget about the initial outlay given for this project. No. The initial outlay we are talking about is the initial outlay coming out of this surplus. The surplus. We have a surplus here. We were to invest in this case here 90, but I mean the project that we got, they only needed 75. So we have this 15, and this 15 we are going to invest it. It's going to become our outlay. It's going to become our initial outlay. I'm not looking at this, so I'm only looking at this. Now listen. So first of all, we start with this present value where n is infinity. How do we get this present value when n is infinity? I will take the amount, we divide by what here? Amount divided by R. You see now here, I know one biggest problem students do. Because like now here, they've told us in note number 3, they've told us any surplus funds can be reinvested to generate a return of 14%. So you get a student telling you, Mwalimu, why don't you take 14% over R? R, which is what here? R, which is the cost of capital, which is 10%. You see, this one we can agree. We can agree that let this be in form of percentage. But honestly, this should be amount. So it has to be 14% of something. It has to be 14% of what was invested. And what has been invested here, this time around for this, we are investing 15. We're investing 15. So if I take this amount over R, I'm able to get the present value. Then to make it net present value, I must come and take the PV minus the initial outlay. And how much have I invested in this? How much have I invested into this arrangement? It is the surplus amount, which is 15. The surplus amount, which is 15. That is what they did to get, in this case here, the 6 there. So the students in this case who told me to repeat, has now this become more clearer, somehow clearer, or have I confused you even more? Remember, it's amount in Kenya shillings over R. Whenever we have an amount receivable indefinitely, in perpetuity. In perpetuity. It's now clear. Great. It's clear. So then can you kindly give me the NPV here? Here there is nothing being invested. Remember, this is zero. This is zero. Go to the third arrangement. I wish this space was enough. This third arrangement, I would want to see whether there is anybody who will be able to give me an amount in form of NPV that I'm going to realize if I reinvest this 20. If I reinvest this 20, how much am I going to get? How much am I going to get? How much am I going to get? How much shall I get? How much shall I get? How much shall I get? So in this case here, we have 8. So this is what here? This is a dash there. If I reinvest this 5, how much shall I get? If I reinvest this 5, how much shall I get? I'm waiting to hear from you. If I reinvest the 5, how much shall I get? I will get 2. Eh? So they're saying it is 2. Of course, nothing there. Nothing there. Nothing there. So perhaps I should repeat. I can see one student saying it's not clear. I mean, this is very easy. This is very easy. Very easy. Remember, I taught you this in class. I told you, we have what we call PVFA. We have what we call present value interest of factor of an annuity, which is 1 minus 1 plus R raised to negative n divided by R. And then we said something here, that when this n is infinity, when n is infinity, the PVFA will be 1 minus 1 plus R raised to negative infinity over R. Then we said, of course, because this is negative infinity, so the whole of this term here will disappear. This is when n is infinity. All right. So basically, this ended up giving us 1 over what here? 1 over R. 1 over R. So then if that is the case, ladies and gentlemen, if somebody wants you now to get present value of some amount, any amount, where n is infinity, we said you take the amount which is in Kenya shillings, you divide by what here, you multiply this with this 1 over R, which will be the same as amount over R. You don't even have to remember this. Any student who has been in my class will be able to tell you that amount, when n is infinity, you take the amount, you divide by R. You don't have to go through this. This is really useless work. Always remember that to get present value, when n is infinity, to get present value of an amount, when n is infinity, you take the amount, you divide by R. Which amount? The amount you have invested. So in this particular case, remember, I mean, not amount you have invested, what you're going to receive. This is the receivable. What are you receiving? So like now here, we have invested because of the surplus. I hope you're able to see where this surplus is coming from. So this surplus, we have invested it. It's 20. But how much are we going to receive? We have a return of 14%. So we have a return of 14%. So 14% of the amount we have invested there, which is 20. So this is what I'll be receiving every year indefinitely. Divide this by the cost of capital. This R is required return, which is the cost of capital. So the cost of capital in this question, they have given me, ladies and gentlemen, the cost of capital is what here? The cost of capital is 10%. So you see now I'm able to get the present value of an indefinite amount. But you see there they want us to give them net present value. How do we get net present value? We look at the total present value over the amount invested. So this is the total present value over the amount invested. How much have we invested in AD? The invested amount is 20. So you subtract 20. So if you do it that way, you'll be able to get that 8. So when you go to BD, for example, in BD, I can see 5. I will come and take 14% of the 5. I capitalize this by dividing this by 10%, minus the amount that I'm investing there, which is what here, which is 5. Is there somebody who is able to see that amount of 2? Is there somebody who is able to see that amount of 2? Is there anybody who is able to see this amount of 2? 2 like that. So I believe it's somehow clear, and you guys now, because of time, I only have 1 hour. I would have wanted to continue doing this throughout. But I want to believe somehow you've been able to see it. because of the limitation that I have, you should be able to allow me to continue a little bit. Is that okay? I have limitation of time. How I wish we had luxury of time. And I'm so sure you guys are bright enough. I'm so sure you guys have been able to see somehow something which can help you to now revise later. Which can help you to revise later. And for the students who are following me online on YouTube, wherever, I would expect you great ninjas of a CPA. Please ensure that you are subscribing to my channel. The guys that I have here on sorry. I don't know what happened there. Sorry. Yeah. Great. That is the good thing with online classes. We teach families. We teach families. We teach families. We teach families. And I'm happy because now I'm able to take straight away the classroom to their homes. Now we have young mothers. Like I'm so sure there must be a young mother. Do we have any young mother around here who has, for example, a 6 months old kid, 3 months old kid? Oh, great. Great. Now you can see this is the essence of what, yeah, proud mama of 2, 3 month old. Great. Young father. Now, this is the most beautiful thing with online class. So I was trying to make a request in this case here for the students who are here in Zoom. Later on, look for Joshua Aura on YouTube. It has about now 16,000 followers. All right. Please ensure that you give me a subscription and ensure that you do what here. Like I normally see so many students telling me that, Mwalimu, you know what? These remedial classes should be put in the LMS. We don't put them in the LMS. Most of the times, I put them in my YouTube. So the students in this case, you have been able to subscribe, and of course, they have rang that bell. You must be getting, in this case here, notifications of the new videos that I really put there like every day. Do we have any member here in Zoom who has been able to subscribe into my channel here? Anybody who has been able to subscribe to my channel? Or still pregnant? There is somebody who's, this is the most beautiful thing with even if you are 8 months or 9 months, you will still be able to benefit. Thank you so much. Great. So then let's get back to this. Let's finish this question. So then let's get ahead and give them the total net present value. Total net present value. So now we need a new table. So we have here AB with the combinations. These are the combinations. AB, we have AC, we have AD. This is a bad one. This is a bad one. So then lastly, we have BD. So is there somebody who is able to give me the NPV of A? NPV of A is how much? Somebody, NPV of A alone. NPV of A alone. NPV of A alone. NPV of A alone. It is here. You can see NPV of A here is 20, and the one of B is 15. So total NPV will be equal to NPV of A. NPV of A is 20 plus NPV of B, which is 15. If we invest in A and B, are we going to have any other net present value from somewhere? Are we going to have any other net present value from somewhere? And if it is yes, how much? Thank you so much, EK. They are telling you, Mwalimu, if we go for AB, there is some amount, somewhere that will be invested, and we shall be able to get a net present value, anew, this 6 years, or this year. So then, give me this figure. Kindly give me this figure. Sauti. Somebody is not able to get one for the math before you are around. Are you guys able to hear Mwalimu? Are you guys able to hear Mwalimu? Yeah, I can see they're even giving me answer. They're able to hear me. Oh, not clear. It must be not clear. Okay. It must be internet. What you want. You are right. This thing fell down. This thing fell down. This thing fell down. Thank you very much, Aaron, for raising that with me. Thank you very much for raising that with me. So now this is 41. This is 41. Let's go with A and C. So the NPV, now I'm getting total NPV. The NPV of A, of course, is 20, plus the NPV of C, which is 40. Do we have any NPV which will, no. The NPV of AC, extra NPV is 0. The extra NPV is 0. So this gives me 60 like that. 60, thank you very much. How about AD? This AD, I can see an extra NPV, but the NPV of A alone is 20, plus the NPV of D, which is what here? Which is 30, plus now the extra NPV, AD. Extra NPV is 8. So can you kindly give me this amount? I'm being given 58. 58. Then we go and tackle B with dog. B with dog. So the individual project's net present value, B is 15. Dog is what here? Dog is 30. BD, the surplus amount will yield a new NPV, which is 2. So this will give me what figure? Somebody here. This will give me 47 from Yvonne. So those are the combinations that we have and the resultant net present values. So which one is the very best combination? Which one is the optimal? Optimal now will be the one that will give us the highest, A and C, the highest, these 60 here, these 60 there. So in this case here, therefore the optimal combination. The optimal combination is A and C. If you do this kind of analysis in an exam, I'm telling you, you'll get a reward. You'll get an award directly from CASNEP. Let me pause a little bit and ask this question. In an exam situation, would you guys have given this question this kind of a thought? Is anybody who would have done this question this way? In an exam, would you guys done this question this way? Would you guys? Or rather, the better question is this. If it comes this time around in advanced financial management, will you manage now to tackle it like this? The better question is now like, if it comes this time in AFM. All right, so thank you so much, ladies and gentlemen. Remember, for you to be able to pass this paper, if you're doing, in this case here, financial management, advanced financial management, there are those areas you must be very good at. So number one, we have this capital budgeting, what we call investment decisions. And if you are doing AFM, you are doing FM, if you are keen, you must have realized that nowadays I'm doing so many questions from this topic. Because either way, whether you are a financial management student, intermediate level, or an advanced level student, you can't survive. You can't pass finance without knowing this topic. Never. And the moment you're good in this, then of course, like if you're an advanced student, if they bring us addition tree, you will be able to tackle it very easily. If they bring sensitivity analysis, if you're doing advanced FM, you'll be able to tackle it very well. If they bring simulation, you'll be able to tackle it very well. So the most important thing in terms of capital budgeting, first of all, is to understand the structure of capital budgeting. The moment you've understood capital budgeting structure, if they bring, for example, like now, if you look at FM or even AFM, these guys will always give us a question on 2 machines, replacement. That you've got this old machine. Now you are thinking of bringing in a new machine. That's why I'm doing AFM for the 3rd time. Yes. But if you know this secret, you can never go wrong. So like now I'll be doing some other class today at 6 p.m. I'll be bringing a question on 2 machines. So today at 6 p.m. you have to attend this class because I'll be bringing the concept of 2 machines. 2 machines. Where we have, in this case here, 1 machine, we have a new machine coming on board. Whenever you have a new machine coming on board, there will be the tax element. There is a tax element that very few students are able to get this tax element because you see there is the disposal of the old machine. When you dispose the old machine, there will always be a profit on disposal of the old machine. That profit on disposing the old machine, very few students are able to get that profit itself. And then number 2, very few students will be able to get the tax on it. And the moment you mess up on that, then you get zero, almost zero for the entire question. And then we'll keep on wondering, why am I failing these things? So today in the evening at exactly 6 p.m., I'll be tackling the concept of how many machines? 2 machines. Will you be available? Will you be available today at 6 p.m.? Will you be available? Yeah, I'll be able to share the link very, very early this time around. Actually, I'll share both. It's AFM, it's FM. That concept comes in the 2 papers, in financial management and in advanced financial management. You must be good at that. Actually, for the students who normally fail FM a lot, I normally advise them. The students who normally fail FM a lot, FM intermediate level, always join the AFM. If you join the AFM class, you get to pass your paper very easily. So then that is number 1. You must be very good in that area. And then number 2, you must be very good. Like now next week, I'll be doing post of capital questions, what we call the financing decisions. And the financing decisions, especially for the students, in this case, who are doing the advanced level, you have to be very good with these concepts of what here, like Modigliani and Miller. Everything is the same in the advanced financing decisions and the financing decisions. Everything is the same except for the fact that now the advanced students will go and tackle Modigliani and Miller, and your examiner would want you to really be good at that. So I'll be able to combine you again when I'm doing financing decisions, but I'll separate you like one session, and then that way you'll be able to overcome. Once you know that, then you appreciate the concept of business evaluation. Then, of course, we have the contemporary issues. Contemporary issues, we have done contemporary issues. Are you able to remember the contemporary issues? We have done that. We have done that. Are you able to remember contemporary issues is available in the intermediate level, and it's available, and it's available, and it's available. It's available in the advanced level. So are you able to give me the examples of contemporary issues? So for example, we have crowdfunding. Crowdfunding. So if you remember very well, crowdfunding, under crowdfunding, we are able to raise our capital from a big population online. So where each member gives what, they think is very small. People will give like 10 bob, 20 bob, 30 bob, but at the end of the day, they are able to give us a huge amount of capital. It is in your syllabus, PA, and you have done this. It is in your syllabus. It is in your syllabus. It is in your syllabus. Crowdfunding. We have Islamic finance. Islamic finance is really a coming up area in finance. You can see like the government of Kenya now wants to float what we call the sukuk bonds. Sukuk bonds. Sukuk bonds, these are bonds that are what here? Islam-based bonds. Remember, in Islam, interest is haram. Very, very good. We must, ladies and gentlemen, be able to remember under these emerging issues in finance, we must be able to remember the blockchain. We must be able to remember the cryptocurrency. Blockchain, cryptocurrency. If you don't have that video, I'll be able to share the video with you. I'll be able to share the video with you. All right. Blockchain technology. All right. All right. So do we have any students who are here because it's a free of charge class? Do we have any students who are here? Great question there. Do we have any students who are here who are our visitors here? They are not yet enrolled at RCM. Do we have any student who is here and they are not yet enrolled in RCM? Great visitors. Do we have them? Do we have them? Do we have them? If we don't have them, let me first of all give them time to respond. So, of course, those ninjas should be able to join us. For revision, we have a very intense revision program this time around. This is our number. A great question. When we meet in the evening, AFM, will I do a question from the AFM past paper? Will I do a question from the AFM past paper? Yeah, I can see Dell saying that he enrolled here with us and you failed. I'm sorry if it's true. You know, at times you could get a ninja from there who's trying to discourage here others, but we shall overcome. Will I be doing in this case here a paper from AFM? A question from, I can do from both. What you want, my friend, is a pass. Whether I'm doing an ACCA question, I'm doing a question from whatever. What you want is a pass. It doesn't have to be, like your examiner can't lift a question easily from AFM. I can show you so many, like the question of two machines. I can show you like 1, 2, 3. These was stolen from the intermediate level. I can assure, in the evening, I'll be able to prove to you. Yeah, great. I'll be able to prove to you. I did 4 and passed. Yeah, that's okay. You should never worry. At times people will come and tell you, I know these things. We know these things, but we shall overcome. It's an oversight. We shall overcome. We have helped so many. In the past. Including that guy who is honest. Just join our revision classes. We shall overcome. So then we shall pass. So then in the evening, not reinvesting into perpetuity. So if you're not reinvesting into perpetuity, then this person will be able to give you for example, he'll tell you that this amount you will invest here, you will get a cash flow of 10 in year 1, a cash flow of 12 in year 2. He has to give you that distributed returns. He must give you the distributed returns. So ladies and gentlemen, I'm grateful and I'm looking forward to meeting you in the evening. I was forgetting a very important thing today. I was forgetting a very important thing today. At 6 p.m., I have advanced management. Why do I forget that paper? So it can't be today. Then the question that I will ask, could we be having any students who are free in the afternoon? I can do that question of advanced, or rather of the 2 machines, and then I send videos. Say at 3 p.m. Do we have anybody who can come and help me, give me figures? I don't want to do it alone. Say at 3 p.m. Great. Then I'll be able to send. I'll send. So it'll be at 3 p.m. because I have AMA in the evening. Thank you so much, team, for reminding me. Thank you so much. Then bye-bye for now. I will send the link and I'll send the video. Thank you so much. Bye. Not for AMA, that will be advanced financial management at 2 p.m. Thank you so much. At 6 p.m., it will be AMA. 6 p.m., it will be AMA. All right.